Well, since we've talked about refinancing and refinancing and refinancing and refinancing, how about refinancing commercial property versus selling it? Let's take a look. Brad Williams, Frugal Finance. What's the scenario? We've been using what's called the box company, so why not go back to the box company? What are they looking at doing? We're trying to figure out the incremental cost of refinancing. Well, this should all be familiar. What's the scenario? Property owners, well, we know you can refinance it as opposed to selling it. But what's the threshold? Is it any different than residential? As we mentioned earlier, when a borrower is given the option between two different debt levels, it is critical to account for the additional cost of borrowing. It's important to keep in mind that the additional cost of borrowing increases sharply in comparison to the interest rate on the larger loan. The analysis of refinancing option also follows this principle. Most of the time, refinancing means getting more money. I'm going to take some cash out to do some renovation. Should the new loan interest rate exceed that of the current one, the additional expense for these funds will be even higher. Let's go back to the box center as an example. Assume for the purpose of this analysis, the box center is eligible to refinance with a loan of $187,500 or 75% of that $250,000. Given a 25-year loan term and 12% interest, the incremental cost for refinancing can be calculated as follows. $200,000, this is existing, 75%, 150, 25, rate is 11%, monthly payment 1470, outstanding loan amount after 10 years, 120. All right, so value today, 250. Refinancing today is 75%, 187.5 based on this 250. Outstanding loan amount after 5 years, 179. Interest rate 12%, term 25. It's all right here. Monthly payment 1975. Incremental cost to refinance. We're using that rate function again. What are we using? We're using 60 because possibly selling the property after 5 years. D49, which is going to be our monthly payment. Our negative D45 is going to be monthly payment, D49. Then our present value is 45067, some change. Our D46, future value, 50,000, outstanding loan amount, 50. Gives us this 1492. Notice we're working in section D here. So the gap between the new loan amount of 187.5 and the existing loan balance of 142 signifies the additional funds acquired through refinancing, totaling 45,068. Calculating the incremental cost of these funds entails factoring in the extra payment post-refinancing of 505. And the added loan balance after 5 years, 50,000. After solving for the interest rate, we find it to be 1493. This rate is what we term as the incremental cost for refinancing. To justify the decision to refinance, the investor must be able to reinvest the proceeds from the box center into another project yielding returns higher than 14.93%. If not, leveraging the funds obtained through refinancing wouldn't result in any favor for the box company. As previously stated, refinancing a property can often yield additional funds thanks to the property increased value. Let's consider an investor who currently owns a property valued at $1 million with an existing loan balance of $500,000, resulting in $500,000 of equity. By refinancing with a 75% loan, the investor now has $250,000 to invest in a second project, assuming a 75% loan could also be secured for the second property. The investor could purchase another property valued at $1 million, although the total equity capital invested remains the same, $500,000. Now spread across two properties with a combined value of $2 million. Additionally, there's an increase in total debt of $1 million. However, as emphasized earlier, this new debt must yield returns lower than the projected unlevered return. Typical notation you're going to get with real estate. They're not mentioning any of the risk factors here. I'm not going to get into the fundamentals, the valuation fundamentals. I will. But again, without recognizing a couple of factors. 1, what are the cash flows? 2, what are the risks? 3, what are interest rates? What are your hurdle rates? In other words, what's your expected return? What's your cost of capital? And so on and so forth. But again, this is just preliminary. This 1492, what's the going rate? This is at 12%. You're taking cash out Are there mutually exclusive projects? Are there inclusive projects that will allow you to take this fund? A lot of questions when you're dealing with real estate. Again, this is just introductory stuff. And I'll leave it at that. Brad Williams, Frugal Finance. Thanks for watching.